Good day, everybody. It's Mark Arnstein from RE/MAX Hallmark. And of course, this is the Mark Arnstein Show. And this is episode number 17. And I'm here today with my very good friend, Mr. Peter Puzzo.
Hi, Mark.
Hi, Peter. Thank you for being here today.
Thanks for having me.
So, Peter, I want to have on today because he is just an absolute wealth of information and knowledge when it comes to mortgages. Peter, obviously, if you've seen him before with us, he's from Dominion Lending, top producers. He's been doing this for over 23 years. And has a phenomenal book of biz and is also a phenomenal source of information and knowledge. And I think given what's going on today in the environment of the rates going up and being as aggressively going up as they have been over the last little while, I think the media has done, and I don't want to harp on this too much because I have talked about it quite a bit, has done an absolutely poor job of really providing the right information to everybody. And they've done more of a job of putting fear into the consumer rather than saying, hey, this is what's happening, this is where rates are going, this is what it really actually means. But we just, did the stats the other day for October, and, if you look at the market as a whole right now in Toronto, specifically, this is what we're talking about, the average price for a detached home since 2019 till October of 2022 is actually still up 27.5% from 2019. So, yes, the market has pulled back a bit, but the rate that we were going through 2021 was so overly aggressive and not sustainable, but the market has still maintained growth, which is the most important thing. So to you, I ask, is given all this crazy environment that we're in right now and what's happened with the rates, what do you see what's going on? Because there's so many things that we can go from, like what's happening with stress tests, what's happening with pre-approvals, what's happening with the fact that rates are getting as high as they are. What does that mean to the consumer? Are they having a harder time qualifying? I'm going to stop and let you answer some questions.
Yeah, there's a lot of questions there, Mark.
Well, when you and I get together, it's like, it's a recipe for a long conversation.
Well, let's start with the last question, which was, is it harder to qualify?
Right.
And the obvious answer is yes. Right. So during the pandemic, the so-called stress test that was being applied was 5.25%.
Right.
Which, call it the stress test, call it the benchmark rate, call it whatever you want. But the stress test is always either that number or your specific mortgage rate plus 2%, whichever's higher. So when we dealt with 2% interest rates, the stress test rate that was being used was 5.25.
Right.
Today, the stress test being used is closer to 7.5. So let's assume the average mortgage today is between 5 and 5.5%. Mm-hmm. Once we add that 2% premium, we get to 7 and 7.5%. So has it reduced individuals' purchasing power? Yes. But you bring up a great point in the reference to 2019, because that's actually the reference that I often use with my team of agents when we talk about volume.
Right.
And I say to them often, well, don't look at 2021 because that was an anomaly. That's just
for sure
not normal, right?
Totally.
Go back to 2019 and say, how do my numbers compare to 2019? So I think that's actually a great point. The fact that we're still up 27% from that time frame says a lot and just, again, reinforces the importance of owning real estate.
No, absolutely. And we say all the time that, and I heard someone else say this before too, is that, look, if you hold on to real estate every 10 years, it basically doubles in the city of Toronto, right? And historically, it has proven to do so. So you can't go wrong. And I think the key important part of this whole conversation we're going to have today is that you do not, and I repeat, do not need to push the panic button. And that's where people need to sit back, relax, and calm down. Now, again, I think the people that are probably the most freaked out right now, those are people that are probably in the variable rate mortgage. And right, so just explain the difference between a variable versus a fixed.
Now, there's two types of variable rate mortgages, but generally speaking, a variable rate mortgage is one where the payment will change as interest rates change, as the Bank of Canada changes the overnight lending rate. The major banks will in turn change the prime lending rate, and that has a direct impact on your mortgage rate if you're in a variable rate mortgage.
Right.
Fixed rates, payments the same, nothing changes for 5 years or 3 years, whatever your set term is. What we're finding now, every bank during this process, the media you referenced earlier, has put a lot more emphasis on jargon and terms we've never heard of before, specifically trigger rates.
Right.
Right. So you're just a consumer that's just minding their own business, and you start hearing these terms. What's a trigger rate? Well, if it wasn't explained to you properly when you first got your mortgage, what it simply means is that as rates rise if your payment doesn't change, more of your payment is going to interest.
Sure.
We get to a specific point or number, call it a trigger rate, a magic number, where if we get to that number, the payment that you're making no longer covers the interest that you owe.
Right.
Based on your mortgage amount. And therefore, the payment needs to trigger,
right.
Meaning they readjust the payment based on your balance, the amortization, and the interest rate at that time, the new rate. So institutions like TD, HSBC are two of the more common ones that we would use. They would have this type of trigger rate impact, as would CIBC, but I'm learning through contacts that CIBC is actually, from what I'm hearing, not triggering clients.
Right.
They're allowing them, and this is as of Friday, a few days ago, they're allowing clients to have their interest accrue,
right.
Even if that means resulting in a negative amortization. In other words, let's assume that the payment that you're making is not covering the interest that you owe.
Right.
That extra surplus will get added to the mortgage.
Right.
And when the term comes up for renewal, we'll figure it out.
Right.
So now, is that good or bad?
Well, it depends on where you're at from when the time comes up for renewal.
Here's what it's good now. It ain't going to be too good when you get your renewal agreement.
Right.
Because you're going to look at it and say, wait a minute, I borrowed $700,000 5 years ago.
Right.
I've been making payments for 5 years. How do I owe $710?
Yeah.
How is that possible? So that's how. Now, what's really important is that the bank communicates this with their consumers and makes them aware of it, because if they don't, all those clients, when they come up for renewal, what's going to happen?
They're going to go others.
They're going to go somewhere else,
yeah.
Because they're going to feel like they were ripped off in some way, right? Now, in CIBC's defense, the flip side of the coin is that it prevents payment shock.
Right.
So as a variable rate customer, you have this static payment, and let's face it, for the most part, we live in a payment-driven society.
Yep.
Right? So you're not panicking. Whereas if your mortgage is with Scotiabank, for example, who has what is called an adjustable rate mortgage, whereby every time the rate changes, your payment changes,
right.
Up or down.
Right.
Those are the clients that we're having more in-depth conversations with, because that's where the panic kicks in.
Right.
Right? The payment every month, they're getting a letter saying, payment's gone up, payment's gone up, payment's gone up. Pete, my payment is 40% higher than it was in January.
Right.
When do these rate increases stop?
Okay, great question. When are they going to stop?
It's a good question.
You don't know the answer?
Well, I mean, look, what we know is what we read from what the Bank of Canada tells us.
Right.
So it appears to be that we are getting close to the end of what we call a tightening cycle, meaning the fact that, they acknowledge that at some point the rates have to stop going up.
Right.
It's just not sustainable, right? Now, at the same time, they've got, an inflation target.
Right.
And we still have supply chain issues.
Yeah.
We have a war going on in the Ukraine, which is pushing energy prices up. We have geopolitical issues in different areas of the world. These are all, and most recently, we have an incredibly robust employment numbers in this country, which kind of caught everybody off guard.
Well, I'm saying I think that's a really good point, and I want to touch on that for 1 second, because it's interesting. You talk about supply chain issues, and part of that is driven by a lot of what the government created with the CERBs.
Yeah.
Sorry, I have my hand in front of my face, which is probably not a good thing when you're doing this conversation, but is that a lot of these people have not gone back to work yet, and there's still massive demand for labor, and there's and people are not taking the jobs. We were just away for both our kids play hockey. We were just in Montreal a couple weeks ago for my middle guys hockey tournament, and the hotel in which we were staying at actually could not operate the restaurant in the hotel for the lunch or dinner because they could not get staff to fulfill what they needed to in order to run the restaurant.
Isn't that crazy?
Which is just insane. Yeah. So I'm like, where are all these people working? Yeah. And so part of me kind of looks at this and goes, hold on a second. we're still looking at very, very low levels of inventory. Yes, sales are down, but inventory is also drastically down, which impacts the number of sales. Because if you have less inventory, you're going to have less sales. It's just obviously those two go together.
Sure.
So, and the other thing we're seeing is that prices aren't really pulling back all that much. They've had a slight adjustment, like I mentioned earlier. So the market was down, say on average 6% from 2021 to 2022, which is, again, we're still up, like I said, 27.5%. So if they're doing all this stuff with the mortgage rates and it's not really having an overall impact where they want to see the market becoming more, consumer friendly, because again, it's supply and demand.
Yeah.
So they're going to have to do something. And then the other thing, which they now just announced, is they're going to bring in all this new immigration coming into the country. Well, that's going to put more pressure on the supply and demand chain, because now, again, with the new rules coming into effect in 2023, with foreign immigration coming in, can't purchase real estate for the first 2 years they live here unless they qualify for the exemptions, which is like you already have a job lined up or you're going to school or some of the other things that I can't remember off the top of my head. But so they're going to have to rent, right? And if they're renting, which is already extremely tight rental market right now, where there's multiple offers happening all over the place because everyone's just trying to get into a rental, and because a rental, for the landlord's perspective, is so tight in how they're choosing their tenants, it's going to then in turn put more pressure on the housing market for people who want to buy.
Yeah, and immigrants typically will flock to those major urban centers, right? So Toronto, Vancouver, Montreal, and they're going to have additional inventory problems, with more demand.
So with that being said, do you see the Bank of Canada rate maybe pulling back at some degree in 2023, or do you think?
Look, I mean, I think things improve when the Bank of Canada says we're done hiking rates for now.
Right.
I think that message will take people off the fence, and I think you'll start seeing more activity.
Right.
I think more buyers will come into the market. I think when that happens, even though the rates are where they are.
Right.
Because over time, you get adjusted to the rates.
Right.
That's just the new norm.
Right.
It is what it is.
Well, and saying this is what I was saying too, is that people are like, I mean, I haven't done the exact math on this per se, but if you think about it, if the markets pull back, say 6% on average, right? So you're paying more for your house last year, but you're paying way less in borrowing costs. Now you're paying about 6% less for the house, but paying more in the borrowing costs. Payments at the end of the day kind of almost equate to about the same, more or less.
Yeah, I mean,
close.
But look, it's again, we talk about again, when you're comparing to variable rates at 1.5%,
right?
It's just not a fair comparison. Like, right, you're comparing to a one-off that really probably only happened because of a pandemic.
Right.
Like, I mean, that's why it's called a pandemic.
Yeah.
Isn't something that happens on a regular basis, right?
Right.
So I think we'll get adjusted to the rates. I'm hoping that some point in 2023, we do see some downward pressure on fixed rates.
Right.
Probably something in the mid-4s would be a healthy number.
Right.
So about 100 basis points lower than where we are today would be nice.
Yeah.
Variable rates, I don't see any pullback in the future at all.
Right.
Again, I think the Bank of Canada probably has another 50 basis points increase in their back pocket, whether they wait until 2023 or whether they do a quarter in December, a quarter in January, whether it's a pause, I think is anyone's guess.
That's right.
But I really do think they need to give these increases some time to play out.
Sure.
And to see what sort of impact they've had. And Benjamin Tall, who's by far one of my favorite economists, increasing rates doesn't fix your supply chain issues.
No.
He's been very adamant about that from day one.
Yeah.
And I'm sure the Bank of Canada is aware of that. And the Bank of Canada, I think in their defense, there's obviously dialogue with the major financial institutions. I think they know how many clients have variable rate mortgages, how many of them trigger at certain points. There has to be some sort of dialogue there.
For sure. And again, the bank is not in the business of wanting to own people's homes.
No, definitely not.
No, they want people to live in their homes and
100%.
Be there.
And for those, I'm glad you brought that up, if I can interject.
Yeah.
For those individuals out there that are panicking about the affordability of their variable rate mortgage payments, I do urge them to reach out to their major banks.
Right.
Because their financial institution, from what I've heard, they'll do whatever they can to accommodate.
Right.
So whether it's, considering an interest-only payment, whether it's increasing the amortization, there has to be dialogue.
Right.
So just as a consumer, be open and upfront with your financial institution. Tell them the truth. I'm having some issues here. What can you do to help me?
Right.
That should be step number one before you talk about moving to another bank and paying all kinds of fees and things like that.
So with this, everything that's going on, and I've kind of been a big believer in this, is that, like your major urban centers, like your Vancouver, your Toronto, your Montreal, aren't going to be, they're going to be impacted to some degree, but not as massive as compared to, say, a Sudbury or, like a Timmins or, somewhere in, a small city in Quebec or out west. But so at some point, I would think the bank has got to look at this and go, wait a second, we're basically ruining these people's lives that are in these smaller places that are like, all of a sudden, they bought the $800,000 home with, because it's CMHC saved with only 10% down, and they're carrying, at the time was like a great and now they're kind of getting into a problematic area. So, are they going to be prepared to step up and do something about that?
That's a good question. I mean, I don't know if that's necessarily, my guess is that that's not the Bank of Canada's problem.
Right.
I mean, that's where each financial institution is going to have some sort of dialogue with their consumers and say, how do we make this work? You bring up a valid point about values outside of Toronto proper. Let's use suburbs, whether it's Brampton, Mississauga. There's no question the adjustments on values there have been significantly higher than what we've seen here.
Yeah.
Right? And expected.
For sure. Yeah. Well, location. Right. Like the golden rule of real estate.
Right. So you take that customer that bought in the peak in January or February in the suburb.
Right.
With the 5 or 10% down, and they're in a variable rate mortgage. Well, now they have payments that may or may not be affordable, and they're underwater.
Right.
So that's where I think we need to proceed with caution, specifically from financial institution standpoint, where that consumer who's smart enough to know that his house is worth a lot less than what he paid.
Right.
I believe strongly that there'll be dialogue between the banks and the consumers, and they'll figure out a way to make it work.
Right.
The banks showed a lot of character during the pandemic to step up and help however they could.
Right.
Whether it was pausing payments. I mean, remember, banks typically take forever to change anything. Any policy is like watching an elephant move. They got together and did a remarkable job of giving us some calm and saying, you know what, everyone relax. We don't know what's going on from a health standpoint, but if you need payment relief, we'll give you that. 3 months, 6 months, and we'll deal with it later at maturity. I don't think they've been given enough credit for that specific move, because for me, I was extremely impressed and pleased that they all got together that quickly and providing us help when we needed it. I see something, that gives me faith. And that if you're a variable rate customer and you're in a situation where you're concerned about your payments, speak to your bank, and something tells me they'll figure out a way to help.
Right, okay. So if you're coming into getting a new mortgage today, right, and you want to have kind of a guide in which to work off of.
Right.
So if we talked about amortizations, like which is time and the length you can amortize the mortgage payments based on 20 years, 25 years, 30 years, which is the max.
Yeah.
What are we looking at right now per 100,000 with the rates being where they are today?
So if you are buying a home with less than 20% down, and we're dealing with a CMHC insured mortgage, interest rates are around 5%.
Right.
If you are buying something with 20% down or more, you can go into a 30-year AM.
Right.
So interest rates are a little higher. They're in the mid-5s. It's going to cost you about $560 per month per 100,000.
So $560 per month per 100,000.
Yeah.
Okay.
And what's also, every bank and brokerage will have their own philosophy. My conversations today with my customers as far as product choice is also very different to what I've had in the last 20 years. I'm liking the 1 and 2 year money,
right?
In hopes that we do have some sort of pullback on fixed rates. I'm not convinced that there's much room for fixed rates to go significantly higher.
Yeah.
So from a risk reward standpoint, I'm advising my clients to go into shorter terms.
Okay, that was actually going to be my next question, because I bought my first place in '97. Yeah, I'm old. And I had a 6.25 back then for a 5-year fix.
Yeah.
Right. So that was '97.
Yeah.
All right. So we're talking, what was that 25 years later?
Yeah.
Right. We're talking like rates are still less than that today.
Yeah.
Right? So, it's not really that bad when you think about it. We've just been so spoiled for so long with having money be as cheap as it ever has been, that it's just going to take that time to adjust to get back in some form of normalcy to understand where we are in this new environment.
Yeah.
But, it's interesting you say, so 1 year, 2 year, because historically, the best way has always been going variable. Would you still do a variable now, or?
No, I would go with the 1 and 2 year term, because by going with a variable rate mortgage, you're still assuming the risk that you would be by going with a shorter term. So meaning, what if rates are higher?
Right.
Well, if you're variable, rates are higher, you're paying a higher rate. And if you're going with a short-term mortgage and rates are higher in 1 or 2 years, you're paying that same higher rate.
Right.
It just gives you more flexibility as far as, do you switch banks at that point? What do you do?
Right.
And every bank today is different. Like some of the banks are more competitive on 1 year money.
Right.
Some of the banks are more competitive on 2 year money.
Right.
So that's the strategy we've taken the last probably 3 or 4 months.
Right. Okay. And if you're coming up for a renewal, and you got great equity, or you're still sitting in the property, would you shorten your amortization period then on that renewal based off of the 1 or 2 year? Do a 15-year M as opposed to a 30-year M?
Listen, if you can afford the payment, God bless you. Yes.
Yeah.
Because remember, we make our mortgage payments with after-tax dollars.
Right.
So paying 5% on your mortgage, if you're making $100,000 a year, it's like paying 7.5%.
Right.
Right. So now, again, the conversation has shifted. During COVID, it's like, no, make the minimum payment, invest your money.
Yeah.
Now it's, no, you're getting a good return by reducing your interest costs. By all means, if you can bump your payment or make lump sum payments towards your mortgage without leaving you cash poor, it's something that I would obviously encourage.
Right, okay. So today, someone's coming in, looking to get a new mortgage. They got good money. They're talking to you because you're the man.
Try to be.
You're the wealth of information. So you're saying right now, as you're coming for renewal, look at doing a short term to get started with, and try and short the amortization period as much as you possibly can.
Yeah.
And the sky's not falling.
No.
Deals are still happening.
Yeah, 100%.
Right.
And remember, you could also go with a 30-year AM if you don't want to shorten the AM, but be with a lender that gives you flexibility in making extra payments whenever you want.
Right. And then, again, and the important thing here with having you here, and this is all due respect to people directly from the banks, is that the advantage of working with a broker like yourself is that you can shop it around to the different banks to get that consumer the best possible deal for them, rather than dealing just with the main institution itself. And that's the advantage of working with a mortgage broker versus working with a mortgage in-house person at a branch.
Correct.
Yeah.
And look, and at the end of the day, all we're trying to do is leverage our experience and just put the client in a place where they're comfortable with their payment, they're comfortable with their product choice, and most importantly, they can make an informed decision. Yeah. Right? Because your major bank, in their defense, is never going to say, go down the street, there's better products there.
No, for sure.
They're going to sell you whatever they're being told to sell you.
Exactly.
So really, the difference with us is just, there's a relationship, there's an accountability, and if you refer me a client and they don't come back to you with glowing remarks, then I've got a problem with Mark Arnstein, right? So it's important that we take care of our customers.
Yeah, and that's why you're here. And and one of the things, we've known each other for I think close to 10 years now, and our relationship is just unbelievable. We're not just a business relationship. We're good friends, right?
Yeah.
And I think that makes a big difference, and it goes a long way because the trust factor is so there, which is so important. And I know I can always call you on a blink of an eye and ask you a question. You get right back to me. You give me always great advice to give along to my clients, which will then come back to you. So it's a very simpatico relationship, which is awesome.
And I value that very much.
Likewise. Peter, thank you so much for being here today. I don't want to take any more of your time because I know you got a busy schedule ahead of you. If people want to reach out and get in contact with you and ask you any additional mortgage information, what's the best way to do so?
If they Google my name, they'll find all the contact info. But Peter at mrmortgage.ca.
Yeah.
Or mobile 905-867-6843.
Awesome. Peter, thank you so much for doing this today, buddy. I appreciate
pleasure,
it.
buddy.
Thanks, everybody, for watching. Take care, and we'll look forward to speaking to you again next time. Bye-bye.